Namaste and welcome back to Market Insights by Prakash. This is part 2 of our 3-part FPI series. In part 1, we broke down the FPI selling in the first half of April. If you haven't watched that yet, watch it first. The link is in the description. Today, we complete the April picture, the second half data, the full month comparison with March, and the DII story that is quietly rewriting the rules of Indian markets. Let's get into it. So, the headline first. In the second half of April from 16th to 30th, FPI sold 12,709 crores. Now place that next to the first half, 48,139 crores, and the message is impossible to ignore. The pace of FPI selling dropped by over 73% within the same month. That is not statistical noise. That is a structural deceleration. The panic phase of the FPI exodus is clearly losing intensity. Let's go sector by sector, but I want to do this differently today. Instead of just reading the April numbers, I want to show you the full March versus April rotation, because that comparison tells the real story of how foreign investor behavior has shifted in just 30 days. First, financial services. The epicenter of 2026 FPI selling saw a sharp slowdown as outflows dropped from 60,655 crores in March to 30,854 crores across April. The consecutive decline throughout April signals an unambiguous shift in momentum. Remarkably, the selling in this single sector during March nearly equaled the entire market's combined outflow for April. This comparison underscores a dramatic stabilization with the financial landscape. Second, in consumer services, FPI selling surged 3.6 times from 2141 crores in March to 7770 crores in April. This spike reflects deepening concerns over discretionary consumption amidst a high crude and high inflation environment. It stands as the only sector where selling momentum intensified so significantly. Third, in healthcare, FPI selling intensified by nearly 1.5 times, climbing to 6926 crores in April from 4638 crores recorded in March. Fourth, in the oil, gas, and consumable fuels, FPI selling rose to 5,479 crores in April, up from 4129 crores in March. With crude oil prices hovering above $90, investors remain understandably cautious about the sector's outlook. Fifth, auto. March saw selling of 12,498 crores. In the month of April, it was 5,479 crores. Selling dropped by nearly 56%. Domestic auto demand data is holding up, and FPIs are clearly done panic selling this sector. Sixth, telecommunications. FPIs reduced their selling in this sector from 5603 crores in March to 4400 crores in April. Significant improvement, but selling persists. Seventh, IT. Selling for this sector continued and increased from 1874 crores to 4212 crores after the weak Q4 guidance season from Infosys, HCL Tech, and Tech Mahindra, triggering fresh exits. 8. FMCG. FPIs reduced their selling from 5419 crores in March to 3205 crores in April. The defensive nature of this sector is bringing FPIs back. And last, reality. The reduction of FPI selling in the real estate sector from 4693 crores in March to 2123 crores in April 26 indicates a significant cooling off of the panic selling seen earlier in the year. Now the buying side. And this is where the March to April rotation becomes truly striking. In all of March, there was exactly one sector where FPIs were net buyers: capital goods at 3148 crores, one green dot in the entire field of red. In the month of April alone, FPIs bought in 5 sectors and with significantly more conviction. First, power. Compared to 230 crores of selling in March, FPIs bought 5,557 crores in April. That is a swing of over 5,700 crores in a single sector within 30 days. India's energy transition, the government's transmission and distribution pipeline, and the renewable energy story are drawing global capital even in the middle of a broader sell-off. Power is now FPI's highest conviction buy in India. Second, capital goods. Buying continues by the FPIs in this sector. Rupees 4,339 crores in the month of April versus 3,148 crores bought across the entire month of March. The buying in capital good is accelerating. Defense manufacturing, industrial equipment, and infrastructure linked businesses are clearly on FPI radar. Third, metals and mines. FPIs turned buyers from being sellers of 3,165 crores in March to buying 1,218 crores in April. China's infrastructure push and the global commodity recovery are directing FPI inflows in metal sectors. Fourth, construction. A complete reversal from 9,154 crores of selling in March to 926 crores of buying in the month of April. A sector that was being liquidated in March is now attracting fresh FPI capital. That is a full 180-degree turn. And last, consumer durables. FPI turned buyers from selling 2,902 crores in the month of March to 80 crores only in month of April. A small number, but a directional signal nonetheless. FPIs see longer term consumption recovery even if the near term is cloudy. The rotation is clear. FPIs have moved from selling everything indiscriminately in March to selling selectively in April, while simultaneously building positions in power, capital goods, metal, and construction. These are not defensive hiding places. These are high growth bets on Indian infrastructure and energy story. That shift in the nature of FPI activity is as important as the reduction in selling volumes. Now, the full month of April, combining both halves, FPI sold a total 60,854 crores against March 1 lakh 17,775 crores. April's number is almost exactly half. This brings the current year 2026 total FPI equity outflow to approximately 1 lakh 91,970 crores, nearly 2 lakh crores in 4 months, and yet the Nifty, after hitting 20 to 182 on April 2nd, closed April near 24,000. That gap between the selling pressure and the market's response is explained by one word: DIIs. For the full month of April, DIIs invested 43,892 crores against FPI selling of 60,850 crores, absorbing 72% of the selling pressure. From January to April, DIIs have pumped over 2.92 lakh crores into Indian equities. The ownership number says it best. DII ownership of Indian equities has hit an all-time high of 20.9%. FII ownership has dipped to 17.1%. For the first time in Indian market history, domestic consumption institutions own more of India's stock market than foreign investors. Powered by SIP inflows now at record levels, this is not a temporary counterweight. It is a permanent structural shift. This is part 2. In part 3, the final video in this series, we go deep into the real reasons behind this FPI exodus. The Iran and the rupee are just two of them. If this analysis helped you see the FPI data more clearly than any headline you had read this month, share this video with one person in your investing circle. That one share puts this information in front of someone who needs it. And if you are not yet subscribed to Market Insights by Prakash, do it now. This level of analysis is completely free every week. I am Prakash Chaudhary, a NISM certified research analyst. Thank you for watching, and I will see you in part 3.